Hi, I'm Realtor Sarah Morrow with South State Ace Realty. Today on Property Time, I'm discussing 1031 exchanges with Ken Palmen of Exchange Resource Group. Ken is a Colorado native who ran his own 1031 exchange company for 7 years before joining the 8-person ERG team 3 years ago. Ken services all 50 states, and he serves as the qualified intermediary in the exchange of real property that's used for business that's anywhere on U.S. soil. He's been involved in over 500 exchanges, and he also serves on the National Council of Certified Exchange Specialists. This designation takes years to obtain. He holds an MBA, and I met Ken by attending his very comprehensive class on 1031s that he offers to local Realtor Association members twice every year. Ken's been married for 26 years, he's got 2 grown kids, he loves all things outdoors, and he's a self-proclaimed old guy soccer player. What a gift to chat with an expert like this today. Hi there, Ken. Thank you so much for being here today.
Hi. Nice to be here.
Thanks. So let's jump right in. Are you first of all a qualified intermediary?
I am.
Awesome. Well, we're gonna get to that later, but why don't you tell us what your role is at your company, what you guys do, and what you love about your job?
Okay. I am with a firm out of Denver by the name of Exchange Resource Group, a dedicated qualified intermediary company, meaning that's all we do is assist clients with 1031 exchanges, and we also try to provide as much helpful information as we can to prospective clients, advisors such as yourself, attorneys, accountants, etc. on the code. My role is Regional Development Director. I have somewhat of a joint role within the firm to conduct business, to find referral partners, again, such as yourself, to teach classes, so very much a marketing role, as well as executing 1031 exchanges with my team for clients, and then also some work on our operations side of things, our documentation, our processes, etc. I love that I get to help clients get a little closer to their dreams through what I do. And it's a win for me, them, and you, for example, as we go along. I love that part of it.
Dreams fulfilled. I love that. Thank you. So 1031, let's start with the name. So 1031 exchange, I'm assuming refers to the tax code, or the references, the section of the tax code is like 1031. Is that correct?
That's absolutely correct. Yes.
Awesome. And does that change over time?
No, it does not. What can change is introduction of refinements to the code.
That's what I meant.
Yeah, typically through what's known as a revenue procedure, and there are some other mechanisms, but Section 1031 of the code itself has been around since 1921.
Right on. Okay, let's get into I want to get to the history afterwards from the early 20s, but let's get into just what is a 1031 exchange. From what I gather with my limited experience, I understand that it's a way for a taxpayer owner, I'm not going to use the word seller, which we'll get to, but the taxpayer owner of a property has a desire to not only defer tax, but to use their equity and roll it over into a like-kind different property, is my understanding. And I guess I'm curious if you could explain the details of what kind of tax are we deferring, what kind of property are we looking at, and how does that play into proceeds, cash, and mortgage debt?
Okay. Yep, that's a lot of what we do and talk about every day. So Section 1031 says, hey, U.S. taxpayer, if you own real property or real estate that is something other than your primary residence, it may qualify under Section 1031 for tax deferral. And that means that any type of real property other than a primary residence has a possibility of qualifying. For example, maybe even a vacation home. It needs to meet some criteria so that, yeah, there is a business or investment aspect to the ownership of that property. But we talk to clients and advisors or prospects about that day in, day out. And in some cases, it becomes a matter of them needing to, or at least we recommending that they talk to their other advisors, their realtor, their CPA, their attorney, about, hey, do I have the makings for a risk-free or very low-risk 1031 exchange with this property or not? And we can give some guidance, but we can't give tax or legal advice that would disqualify us from being a qualified intermediary.
Sure.
Potentially all taxes otherwise due are deferrable under 1031. It's not just capital gains, which is a misnomer around 1031. So if a property in question has a structure to it, say it's a rental, then that property is part of the depreciation recapture system, right, in our tax code. So as someone owns that property, they get to depreciate a percentage of its value every year. While when you sell that property and have gain, the IRS says, we want 25% of that benefit back in the form of a tax. And then we also want capital gains tax collected. The state wants its share. Most states have an income tax. The feds also have what's known as the Medicare surcharge. Technically, it's the net investment income tax, NIIT. That adds another 3.8%. That's income banded. So is capital gains. So as you or my income rises, we go from 0% capital gains due to 15%, and then if you break through that ceiling, all the way up to 20%. And it is possible to defer all of those taxes with a 1031 exchange, given full reinvestment from the net sale price. And we'll talk about that a little later.
Wow.
Yeah.
So we're not just talking about a little capital gains that you can kind of, shirk away in a couple of years. We're talking about a huge burden lifted like that.
Yes. A lot of people we talk to will say, oh, well, maybe I'll just pay the 15% capital gains. And 5 minutes later, with just an overview like I just gave, they're thinking, ooh, I might be at 25% or higher. Maybe I at least want to go talk to my accountant, or take a little closer look at my gains before I decide against a 1031.
One of your many value adds is opening people's eyes to the fact that it's not just capital gains, I'm sure.
Right.
Which leads me to my next question. You mentioned this cannot be done on a primary residence.
Correct.
So this really is a real estate investor strategy, and it can be done with commercial, residential, sounds like it's land, farms, any rental you might own. It's really designed to kind of help investors.
Definitely, right. So any type of real property can qualify as long as it has a business or investment hold aspect. Someone can even participate in a 1031 exchange with their primary residence or their home if they have a split use. For example, I run a business out of my home, or I happen to live on a ranch and I lease out 5,000 acres of land to other ranchers. That is a formula for, okay, I have part of that value that's not eligible, but part of it is under 1031.
Yeah, so let's talk about that since we're on the topic. Is it safe to assume that since 1921, this was kind of I hate to use the word good old boys, but this must have been started with farming, with keeping business at the home and vice versa, to keep the heirs of a farm from paying tax, right? Like I've heard there's a huge tax benefit to having agricultural land or a business. It sounds like you're kind of alluding to this fact that like if I'm a wheat farmer and I want to go become a corn farmer, well, I'm not going to get penalized for that as long as I can roll this over into a different type of farm. Is that sort of the history behind this? And can you talk more about, how this used to affect us and why it's still going? Like I know we're going to get to how it benefits heirs, but can you speak to, is that how this American dream kind of gets started?
Yes. When this code was proposed, it was meant to take away that penalty of tax essentially to farmers and ranchers as they expanded lands, as they transitioned to their kids or other beneficiaries. And at that time, even as they increased livestock herds. So back when the code was founded and put into place, it was possible to 1031 exchange personal property, including livestock. Now that all went away with the Tax Cuts and Jobs Act that was introduced and for the most part took effect January 1, 2018. So from that point forward until now and for the foreseeable future, 1031 is only applicable to real property. Personal properties off the table. But again, like kind is a very broad definition, and as you mentioned, it can be something with the structure, raw land, water rights, mineral rights, fractional ownership, on and on and on, as long as both what's being relinquished and replaced are on U.S. soil or on foreign soil. You just can't go between U.S. soil and foreign within an exchange. And the exchanger or the taxpayer has that intent to hold for business or investment use, and it's defined as real property. So you or I could sell a condo that's been a rental, and we could buy some oil and gas rights in Texas and a portion of a strip mall in Pennsylvania. That all works within a 1031 exchange structure.
Cool,
Yeah.
Cool. That makes sense. I want to circle back, well, really quick before we leave this topic. Do you have to have an LLC or a business entity attached to be able to do a 1031, whether it's your primary residence where you do business or not? Or can it be an individual that is a business owner?
Yep. Any taxpayer who has an obligation to the IRS can participate in a 1031 exchange. So our clients are single people, married couples, trusts, corporations, LLCs, on and on. There is a same taxpayer requirement that says whatever tax ID number or numbers starts an exchange needs to finish it. So we will often talk about that with someone, or their advisor as they're getting set to make some transactions. Could get into some topics where we may say, run it by your tax advisor as well. Again, we can't give tax advice. Go double check that what you want to do works as far as your accountant's, understanding and blessing.
Sure. And I know that's very important for all of us. We are not attorneys, disclaimer. You mentioned the word qualified intermediary, so I want to talk more about the cast of characters. This obviously takes a village. I know the word seller isn't really to be used even though you're the owner taxpayer, because in my understanding, the qualified intermediary, or QI, becomes the seller on behalf of this business or entity or individual, if you will. Can you talk a little bit more about the roles, the hats, who's involved?
Sure. A qualified intermediary, QI for short, is required by the code in almost all scenarios. And they become, or a company like myself, become involved as the middleman to do a few things. One, somewhat unofficially, we provide information on 1031. What you can do, what you can't do. Here's what the code says. Here's what case law says. Here's how it's been applied in the real world. Secondly, we provide the paperwork. Some of it is typical American, contractual stuff. We have an agreement with the exchanger. We have an agreement with a bank or financial institution and the client and us, where proceeds are going to be held as required by the code. And that's the third thing we do, is hold funds for each exchanger in the most secure manner possible. And the other parties are unchanged from a sale or a purchase that does not involve a QI. So really, the QI is the only addition when a 1031 is involved.
And they are technically the seller.
Yes, we do operate, again, as a requirement of the code, through an assignment. In the old days of the code, the QI actually took title to what the exchanger was selling and then relinquish title to the buyer. Well, fortunately, that went away as I think technology developed, but that formality remains. So there is an assignment that the exchanger would sign off on saying, I'm allowing Exchange Resource Group or my other QI to act as assignee for this sale or for this purchase for purposes of a 1031 exchange. And then the other party, so if you're selling as the exchanger, your buyer is going to receive an acknowledgement, a notice of assignment, and that's also required by the code.
Understood. So I kind of asked it, but we went in 5 directions. Can you talk about mortgage debt? Because I'm not clear. First of all, is it true that I'm not earning one single dollar when I roll over equity and just like-kind it? Is it true that I'm getting no proceeds at the closing table? And then if so, what about closing costs and what about my mortgage?
Yep, okay. That's important stuff.
Common question, I'm sure.
Yep. So the code does not distinguish between debt and equity. The code says, exchanger taxpayer, to the extent that you reinvest to your net sale price, meaning your gross less your closing costs, you are eligible for 1031 deferral. So if you have no debt, then it's just a matter of what was your cash proceeds and do you choose to reinvest all of that to maximize your 1031 deferral and possibly have a fully tax deferred event? Or do you want to take some of your proceeds when you sell? You can still have a good 1031 exchange, but you're going to pay tax for the amount you pull out when you sell. Or if you get money back at the end of the exchange, that's also taxable. And then when it comes to debt, the IRS says, okay, if you have debt on what you're selling, you need to replace that debt, just as if it's cash. And you can replace it with either new debt or you can add cash. If you have another resource, okay, I'd rather not have a mortgage or less of a mortgage on my new property, I'm gonna add some cash. That works to get you to your reinvestment goal of your net sale price and hopefully maximum or full deferral for your 1031 exchange.
So not only are hundreds of thousands of dollars being saved in taxes that an investor can use to reinvest with, which is the perk of this strategy, you also get a little flexibility. So I could opt to take a little slice of my net proceeds and not reinvest it, right? As long as I still have greater or similar debt, right? Doesn't it have to matchy-matchy?
Doesn't have to match exactly. And so yes, you and any exchanger can make that decision. And again, there's a lot of misinformation on that point. A lot of people believe, oh, I have to buy something of more value or at least equal value to what I sold. No, you don't, but you're gonna have tax exposure for the gap.
I see. Yep. As long as you're paying your tax burden accordingly with whatever proceeds you earn, it's like you said, it was an event.
Right.
You gotta pay sales tax.
Yep.
Okay, wow, that's really, you are kind of opening my eyes to some of these nuancy misnomers. I still, you did define qualified intermediary, and we talked about the taxpayer, I guess, is sort of the owner. Is there anybody else involved? You said like an attorney, or can you kind of check off all the other boxes other than buyer and realtor?
We try to inform every prospect we talk with to the fact that we recommend they have tax and or legal counsel weigh in. There could be a gain on a property and someone thinking, oh, I need to do a 1031 exchange, but it turns out they have a loss on a business that we don't know about, maybe they forgot about. They may not have a net gain once they factor in that loss in another part of their financial picture. So there are a lot of reasons we recommend that someone considering a 1031 exchange get with their CPA. If it's a more complex commercial deal, maybe they want an attorney involved as well, or an estate attorney if it's an estate matter.
This is such a rich topic, and we are running out of time. I want to talk about timing because it seems really critical. I know there's a 45-day sort of searching period where you have to identify a property.
Yes.
And then I think the whole thing has to be totally done, signed, sealed, delivered within 180. Is
Yep.
that still the case? And can you talk about this time of the essence? Like, inventory's low. Do
Right.
people get desperate? Like, are there exceptions? Is this an IRS thing? Like, what's up with the timing?
The time frames you mentioned are dead on. 45-day identification period says from date of first closing. Most of the time that's a sale. 5% or less of the time we may be working with someone in a reverse exchange where they're going to purchase first and sell later.
Ooh.
But any type of 1031 exchange has a maximum 180-day exchange period and a 45-day identification period. So the IRS, with those rules, says, okay, exchanger, from the date of your first closing, you have 45 days to either close on what you want to close on as a replacement property, or if you'd like more time, to submit a written identification with fairly restrictive ID rules. Send that into the QI. And if you do that, we'll give you another 135 for that 180-day total, start to finish, maximum time frame allowed. So our recommendation to clients, advisors, is move as quick as you can on that replacement property if you're doing the more common forward or direct exchange where I'm selling first, or straight exchange would be another term for it. There's no restriction in the code as to when you can make offers or go under contract for that new property. And maybe you're not competitive until you've sold because you don't have cash in hand, but doesn't mean I can't work with you to find out where do I want to look, what are my price points, how many properties do I want to buy, so that I'm ready to go. And hopefully by day 45, if I need more time to close, I'm at least under contract, and I feel pretty confident that I'm going to be successful in closing and having 1031 exchange benefits.
Yeah. You want that cushion. I mean, talk about stressing out your realtor.
Right.
Right? I need this, this, and this, and this by this date. Like, I'm not a magician. Okay, thank you for explaining that. The other thing I really want to make sure we get to is step up in basis. And I want to talk about how the IRS really not only seems to be rewarding investors here and business owners, but like children, heirs. I mean, like, I want you to tell me how awesome. I think it's really awesome if your parent did one of these and deferred tax, and because don't you get not only that step up in basis, but can't you just like sell tax free?
Yes.
Is that true?
It is an awesome part of our tax system. And the experts my team and I listen to and read up on seem to indicate that's not changing anytime soon.
Right.
You know, hopefully not for decades or ever. And basically it says, okay, deferral can be forgiven through the transfer of assets to beneficiaries, right? Most commonly kids. So if I accrue a greater and greater portfolio of investment real estate for the rest of my life, I'm benefiting, right? Because I'm able to build my wealth more quickly with 1031. I don't have to carve out 25% of my gain every time I sell. I get to put that in new real estate. And if I keep doing that and 1031ing out of my former property and into something with equal or greater value, probably greater value each time, great, I'm earning more income, right? I'm going to pay tax on that income, but I'm still building my wealth. And when I die, my kids receive step up in basis, which means they receive those assets with a market value based on the date of my death. And that deferred tax is forgiven to them. And if they choose to sell one or more of those assets right after I die, they don't have gain to report. If they choose to hold it for 10 years and then sell it, they only have tax for that period of 10 years from when I died. They got it at that date's market value to when they sold it. So it is very powerful, and we try to let everybody we can know about it.
Doesn't that just make you feel like a heel for buying your kids like normal Christmas gifts and such? It's just so generous.
Right.
I don't know, this country is really built on marriage and kids and farming, like the American dream, and we get rewarded for doing these things. It's really fascinating to me, and I appreciate you explaining that and underlining. I mean, I don't have heirs, and my parents didn't do any 1031s, but what a gift, right?
Right.
I guess the last question I have, and I just have to mention it because it's so funny. Talking about farmers, talking about old school 1920s, what's boot?
Yeah, okay, good question. So boot is the IRS's term for anything not like kind to real property. So basically anything that's taxable in a 1031 exchange. And usually it's cash. So again, if I do an exchange and I elect to pull some cash out when I sell to start my straight exchange, I've created a taxable event and I can't fix that later. Or if I receive cash back at the end of my exchange because I didn't reinvest at all, or if I don't replace debt I relieved in my exchange with new debt or additional cash, I've got mortgage boot, meaning I received something not like kind to new property and I owe tax on that debt that I didn't replace.
I think I follow. Can you talk about, I'm still a little bit fuzzy on closing costs and mortgages. Can you just talk more about how boot might, I don't get it. Okay. I don't get debt.
Sure. So I put it to folks I talk to like this. Your reinvestment goal can be arrived at one of two ways. Take your gross sale price and back out your closing costs to arrive at it, or picture that same settlement statement and pick out the cash proceeds line item and the debt relieved or the mortgage payoff line item and add those two together and you're going to get that same number.
Which is considered net.
Correct.
Okay.
That's what we refer to as the net sale price and the reinvestment goal.
Got it.
And then keep in mind, and we have clients do this quite often, let's say I sell for a gross 530, net 500. I find a great replacement rental for 475.
Yes, that's my question.
Okay. Now, and again, it doesn't matter if I had debt on my property that I sold or not, my reinvestment goal is still 500.
Oh, okay,
right?
okay.
It's that combination of cash I got and any debt I relieved.
Okay.
I need to replace both of those things.
Understood. So you are paying off the debt.
Yes.
At
upon
the time
closing.
of closing. Okay.
Correct.
Okay. You're
Yes.
not rolling debt. You're not rolling boot. There's just this now. Okay, here's my credit card balance. I'm going to go shopping. This is what I'm looking for.
Yes.
That's my reinvestment value.
Yep.
Okay, got it. Well,
That's right.
Listen, Ken, you've brought a lot of attention to a lot of things, and my brain's going to
Cheers.
explode. I hope this was helpful. That's the property.
Thank you.